Good evening, everyone. Welcome to the channel. Before I begin, here are my disclaimers. Today I am going to give you an update about Colgate-Palmolive Company Annual Report. Colgate-Palmolive Company offers a diverse range of consumer products across two main segments: oral, personal and home care, and pet nutrition. The oral, personal and home care segment provides an extensive list of personal care items, including toothpaste, toothbrushes, mouthwash, hand soaps, shower gels, shampoos, conditioners, deodorants, antiperspirants, skin health products, dishwashing detergents, fabric conditioners, household cleaners, and more. These products are sold under various brands such as Colgate, Palmolive, Darlie, Elmex, Hello, Meridol, Sorriso, Tom's of Maine, Elta MD, Filorga, Irish Spring, Lady Speed Stick, PCA Skin, Prodex, Sanex, Soft Soap, and Speed Stick. In addition to personal care products, the company also offers pharmaceutical products for dentists and oral health professionals. The pet nutrition segment provides pet nutrition products under the Hill's Science Diet brand, catering to everyday nutritional needs of pets. This segment also offers therapeutic pet products under the Hill's Prescription Diet brand, designed to support dogs and cats in different stages of health. Colgate-Palmolive Company markets and sells its products through various channels, including traditional retailers, e-commerce platforms, wholesalers, distributors, dentists, skin health professionals, pet supply retailers, veterinarians, and online retailers. Colgate-Palmolive Co.'s stock price has increased by over 7.8% in the past year, driven primarily by strong financial results and a positive outlook for 2026. The company's fourth quarter and full year 2025 earnings beat analyst expectations, with an EPS of $0.95 and quarterly revenue rising by 5.8% year-over-year to $5.23 billion. The record full-year 2025 performance saw net sales reach $20.38 billion, with organic sales increasing by 1.4%. The company also reported a record net cash provided by operations of approximately $4.2 billion, and returned $2.9 billion to shareholders through dividends and share repurchases. This demonstrates strong financial health and commitment to shareholder value. Management expressed confidence in the company's growth momentum, particularly in oral care and pet nutrition, and provided positive guidance for 2026, forecasting net sales growth of 2% to 6% and organic sales growth of 1% to 4%. The unveiling of a new strategic roadmap for 2030 also boosted investor confidence in its long-term growth prospects. Favorable analyst sentiment, with several analysts maintaining a moderate buy consensus rating, further supported the stock price increase. Colgate-Palmolive Company market capitalization of $78 billion is significantly larger than the average industry peer of roughly $1 billion. This shows that Colgate-Palmolive Company holds a significant advantage in their industry. Colgate-Palmolive Company trades at a higher price-to-earnings ratio of 37 times and a higher price-to-book ratio of 1,449.25 times relative within the industry. This makes the stock appear much more overvalued compared to its peers. However, the broader industry is also trading at elevated valuation levels, suggesting sector-wide optimism rather than company-specific overvalue. Investor should evaluate if the stock is worth its premium price. The company exhibits a very high leverage profile, with liabilities accounting for 97% of total assets. This elevated debt level warrants heightened caution, as it may limit the company's financial flexibility and increase risk during economic stress. We have to further examine the industry and the nature of the business to determine if they justify the current valuation. Liabilities have grown faster than assets and equity, which is somewhat concerning. However, asset growth remains positive, suggesting management may be temporarily leveraging liabilities to fund expansion. Shareholder equity has declined over the past 5 years, but operating income remains positive. The equity weakness may stem from capital structure changes such as buybacks or dividends rather than operational deterioration. The company has consistently reduced its share count, reflecting a shareholder-friendly approach to capital allocation. The company have a dividend yield of 2.14%. The income statement shows that the company have been growing its revenue annually, and the operating income have been increasing. This shows that the business model works and the business is expanding. The primary drivers of revenue growth or decline can be identified through a thorough analysis of various factors. On the growth side, organic sales growth, net selling price increases, and volume growth are key contributors to revenue expansion. Additionally, positive foreign exchange rates, strategic acquisitions such as Prime 100, and increased promotional programs also play a significant role in driving revenue upwards. In contrast, revenue decline is often driven by factors such as volume declines, negative foreign exchange rates, and weaker than expected performance in specific regions like China. Lower than expected category growth rates and decreased sales volume are also common causes of revenue decline. Furthermore, reduced price increases, increased sales returns, and decreased promotional programs can all contribute to a decrease in revenue. It is worth noting that certain segments exhibit significant revenue growth or decline. For instance, the Africa/Eurasia segment experienced substantial growth in 2025, while the North America segment declined in 2024. The Europe segment has consistently shown declining revenue over the past 2 years. Conversely, Latin America and Asia Pacific have seen notable increases in revenue. The net income of the company experienced a mixed trend in 2025 compared to 2024. While it decreased significantly in some instances, such as a 23% drop from 2024 to 2025, it also showed an increase of $170 from $12,181 to $12,251. However, there is limited information on the net income change in several pages. The profit margins of the company declined substantially in 2025 compared to 2024. The gross profit margin decreased by 40 basis points, BPS, and 50 BPS for GAAP and non-GAAP respectively, while the operating profit margin dropped by 500 BPS to 16.2%. This decline can be attributed to various factors including volatility in material costs, increased competition, changes in customer policies, consolidation of retail customers, uncertain global macroeconomic conditions, disruptions in credit markets, inflationary pressures due to global trade relations and tariffs, and the impact of the war in Ukraine on operations. The reasons for these changes are multifaceted. Volatility in material costs and increased competition have been significant contributors. Additionally, changes in customer policies and consolidation of retail customers have also played a role. Uncertain or unfavorable global macroeconomic conditions and disruptions in credit markets have further exacerbated the situation. The war in Ukraine has had a direct impact on operations, while goodwill impairment triggered by changes in circumstances in the Skin Health Reporting Unit has also been a factor. The company's financial performance has shown a significant improvement in recent years. One key indicator of this growth is its ability to generate positive operating cash flow. According to the latest data available on page 51, the company achieved a substantial milestone in 2025 by generating $4,198 million in positive operating cash flow. This achievement demonstrates the company's financial stability and its capacity to manage its operations efficiently, resulting in a significant increase in its bottom line. The company's debt level has undergone significant changes over the past few years. Initially, long-term debt increased from $7,941 million to $7,986 million between 2024 and 2025. However, this trend was short-lived, as subsequent reports revealed a decrease in long-term debt from $7,289 million to $6,871 million during the same period. This fluctuation suggests that the company's debt level is not stable. Regarding interest expenses, there are mixed signals. On one hand, interest expense decreased by $20 million from 2023 to 2025. On the other hand, interest paid only decreased slightly from $302 million in 2023 to $280 million in 2024. Furthermore, a report suggests that interest expenses may have changed due to the redemption of high-interest debt and issuance of new debt at lower interest rates. This implies that while there is some reduction in interest expenses, it is not a straightforward decrease. Management is reimagining a healthier future for all people, their pets, and the planet through its marketing brands and authentic workforce. However, they acknowledge several risks that could impact the business, including supply chain disruptions, commodity cost increases, and geopolitical tensions. The company's operations in the Eurasia region have been affected by the war in Ukraine, but this is not material to consolidated financial statements. Management expects to continue experiencing challenges related to the war, including supply chain and logistics issues, import restrictions, and foreign currency volatility. In terms of business performance, management notes that the skin health business has experienced weaker performance in China, while the company has entered the fast-growing fresh pet food category in Australia through an acquisition. The global macroeconomic, geopolitical, and market conditions are expected to remain challenging. Management highlights cost savings initiatives as a positive factor, which partially offset the decrease in gross profit margin due to higher pricing and favorable mix. However, the company is vulnerable to product recalls, withdrawals, or reformulations due to perceived defects or safety issues. The effective income tax rate decreased from 22.9% in 2024 to 26.1% in 2025, while the non-GAAP effective income tax rate increased slightly from 22.7% in 2024 to 23.1% in 2025. Management believes that Pillar II will not have a material impact on the company's business. In terms of regional performance, net sales in North America decreased due to volume declines and negative foreign exchange, while net sales in Latin America increased despite a decrease in operating profit. Net sales in Europe increased driven by volume growth and positive foreign exchange, but operating profit in Asia-Pacific decreased primarily due to higher raw and packaging material costs. Management is confident that the company's strong cash generation and financial position will continue to provide access to global credit and capital markets. However, there are uncertainties related to medical cost trend rates for post-retirement benefits and pension plans, as well as stock-based compensation, asset impairments, and tax positions. The company has made several strategic acquisitions to expand its product offerings. One notable acquisition is the Prime100 pet food business from Care Topco Thai Limited for $301 million in April 2025. Additionally, the company acquired Filorga, a skin health business, although no specific date was mentioned. The Colinos oral care business was also acquired from Wyeth in 1995. In terms of divestitures, there is limited information available. However, it can be inferred that some form of disposal or divestiture may have occurred due to the mention of restructuring and related implementation charges. Despite this implication, no explicit details are provided regarding any specific divestitures made by the company. The company has demonstrated its commitment to returning value to shareholders through both dividend payments and share buybacks. In terms of dividends, the company has consistently paid out significant amounts, totaling $1,823 million in 2025 and $1,789 million in 2024. Additionally, it has also made dividend payments on Employee Stock Ownership Plan (ESOP) shares, amounting to $15 million in 2025 and $16 million in 2024. Furthermore, the company has been actively buying back its own shares, with a total of 13.7 million shares repurchased in 2025 for $1,210 million and 18.3 million shares bought back in 2024 for $1,739 million. This share buyback program is part of a larger initiative, with an aggregate purchase price of up to $5 billion. These actions demonstrate the company's focus on maximizing shareholder value through both dividend payments and strategic share repurchases. Supply chain disruption concerns abound. The extracted summaries reveal a plethora of concerns regarding supply chain disruption. One of the primary concerns is the impact of geopolitical events, such as wars and military conflicts, on the availability and cost of raw materials and commodities, page 7. This is further exacerbated by exchange controls, import restrictions, foreign currency volatility, and reputational concerns in regions like Eurasia. Changes in customer policies or practices can also disrupt supply chains, particularly if a key customer or distributor is lost, page 8. The consolidation of retail customers globally may increase concentration risk, making companies more vulnerable to disruptions. Geopolitical events, tensions, wars, and military conflicts are another significant concern, as they can lead to widespread health emergencies, strikes, labor disputes, and disruptions in logistics, page 11. The loss of key suppliers or contract manufacturers can also have a devastating impact on supply chains, page 12. Capacity constraints, raw material availability and quality issues, industrial accidents, and governmental incentives, regulations, and controls can all contribute to supply chain disruption. Furthermore, natural disasters, including climatic events and earthquakes, cybersecurity incidents, and volatility in material costs are all potential risks. Tariffs and trade relations can also impact the cost and availability of raw materials and products, page 25. Increases in costs and limitations on availability of raw and packaging materials, as well as supply chain and logistics challenges, import restrictions, foreign currency volatility, and challenges to protect assets in Russia, are all concerns mentioned throughout the summaries, pages 26. Foreign currency exchange rate volatility and commodity price fluctuations can also impact supply chain operations, page 54. Overall, it is clear that there are numerous concerns regarding supply chain disruption, but none explicitly mention inventory buildup. That concludes the financial summary for Colgate-Palmolive Company. Feel free to comment below, and I will be happy to answer them when possible.